Something huge just happened and hardly anyone noticed. The United States quietly forced its two biggest banks, JPMorgan and Bank of America, to pull out of a $5 billion Chinese IPO in Hong Kong. No press release, no public statement, just a cold, simple instruction: back out. No warnings, no negotiations, just one calculated move. So how did China respond? Not with angry speeches or official statements. In fact, not a single word was said. Just silence. But within 72 hours, China made its move. No missiles, no sanctions, just money. $78.5 billion in United States Treasury bonds vanished from China's books. Gone. This wasn't your usual trade fight. No tariffs, no heated tweets. This was a quiet financial earthquake, and it might have just rewritten the rules of global power. The spark that ignited all this? A Chinese company called CL Battery. At first glance, it seemed like any other tech IPO. It specialized in lithium-ion batteries, the kind that power everything from electric cars to military drones. But here's where things got complicated. CL reportedly had ties to China's defense sector, and that made Washington nervous. To U.S. intelligence, this wasn't just a battery company. It was a national security risk hiding in plain sight. Meanwhile, Wall Street saw an opportunity. Banks like JPMorgan were ready to cash in on one of the biggest IPOs of the year. But then, without warning, the U.S. government stepped in. They didn't just block CL Battery from listing in New York. They ordered American banks to pull out of the deal in Hong Kong, China's own financial turf. That crossed a line. CL's valuation immediately dropped by $210 million. But the real damage wasn't just to one company. It was to the global financial system. The world saw in real time that U.S. money no longer follows market logic. It follows geopolitics. And when trust breaks down in finance, money starts shifting in unpredictable and dangerous ways. China didn't issue a press conference, didn't make threats, just quietly began moving money out. Within days, China's state-owned banks started selling off U.S. treasuries, not in one huge drop, but in careful, calculated steps, like a chess player giving up lesser pieces to set up checkmate. By the end of the first quarter of 2025, $78.5 billion of U.S. government debt had disappeared from China's portfolio, the largest sell-off since 2016. And here's the chilling part. It wasn't done out of panic. Barclays analysts called it a diversification strategy, a fancy way of saying China is quietly building an escape plan from the U.S. dollar system. To see how serious this is, think of U.S. treasuries as the foundation of America's financial power. They're what gives the dollar its global influence. So every bond China sells is like pulling bricks out of that foundation, piece by piece, quietly and relentlessly. Where's all that money going? Not into more U.S. assets, that's for sure. Instead, China is drafting a whole new blueprint for global finance, one that doesn't rely on the U.S. dollar at all. It starts with gold. Trading on the Shanghai Gold Exchange just hit a 5-year high. China isn't just buying gold, it's using it as a reserve anchor, something no country can freeze with sanctions. Then there's the yuan. Once a side player in global finance, the yuan is now being used for massive international deals. Look at Saudi Arabia. They issued a $4 billion bond in yuan, and demand was 4 times higher than supply. Why? Because investors see what's coming. Don't forget China's infrastructure push. Through projects like the Belt and Road Initiative and BRICS plus development banks, China is offering funding outside of Western-controlled systems. Even quieter is the rise of the BRICS payment system, an alternative to SWIFT. Transactions have surged 320%, essentially creating a shadow internet for money beyond US oversight. And this isn't just about China anymore. It's a financial lifeline for countries tired of US sanctions and dollar dependence. Meanwhile, Washington is making a risky move of its own. A new bipartisan bill is picking up speed, one that could force US investors to sell off more than $812 billion in Chinese stocks and bonds. We're talking major players like BlackRock and Goldman Sachs. Scene 10. Forced separation. Under this proposed law, 220 Chinese companies would be labeled strategic threats, blacklisting them from U.S. investment, no matter their performance or demand. This isn't just regulation, it's a forced separation. Profits or patriotism, investors will have to pick a side. So what happens when Wall Street pulls back? Who fills the gap? Spoiler alert, Shanghai is already preparing. Stock exchanges are being upgraded and capital is being rerouted. It's like Wall Street left the party, and Asia is building its own. Dozens of Chinese companies are voluntarily delisting from U.S. markets, not because they're failing, but because they see the storm coming. And the trend is spreading. Even Southeast Asian companies are bypassing New York and NASDAQ in favor of Shanghai's growing international board. In just a few years, Shanghai has amassed $112 billion in foreign listings, something unimaginable a decade ago. For decades, U.S. financial dominance was built on being open, stable, and reliable. But by using its financial system as a weapon, the U.S. is now seen as unpredictable, and money doesn't like uncertainty. Quietly, company by company, listing by listing, capital is flowing away from Wall Street and toward a new system being built in the East. This raises the big question: what happens if the world no longer needs the US dollar? In 2000, the dollar made up 71% of global currency reserves. Today, it's just 57.4%, a 28-year low. That's not a blip, that's a trend. And what's taking its place? Not one currency, but many. The yuan, the euro, gold, and emerging alliances like BRICS Plus. This isn't about crashing the US economy, it's about creating options.